Hey everybody, Signet here with the Bullish Bears. We're going to be talking about Alibaba this morning. So on leaderboard from IBD, Alibaba's in a buy zone. You can see the buy zone that I've got marked out here on the chart in the upper right corner. Today is October 22nd. It's before the bell. And right now we're up on elevated volume and we're up around $3, I believe. We'll bring up the leaderboard and take a look at that. So this is leaderboard from IBD. I'm not trying to give them any kind of commercial or anything, but this trade is based on their buy zone. If you haven't had any exposure to IBD or leaderboard, what this uh, buy zone is based on are really strong companies that have increasing volume and are at a buy point based on a weekly time frame. So if we go out here to the weekly time frame, we'll just kind of make this really nasty looking. What they focus on at IBD is a market with one of three patterns: a cup and handle, a base, or uh, a double bottom. So they focus on that on the weekly time frame, and then they look for a market that breaks out, and this buy zone is breaking out of this wick way back here. So a market that breaks out, this whole range becomes the buy zone, and they're looking for a follow through, just like they had here. That was another one of those. And just like they had here, where the market formed the base and then broke out. So that's the setup that they're looking for. And then they go and get into it with stock. Now I've already got the stock. I've been in the position for a few days, just kind of hanging out in there. But I want to put on an options trade. So the idea with this options trade is we want to be very careful about what our goal is in this trade. If the market does break structure and begin to fall, at that point, might have to think about killing the trade. Now, me personally, the size of the trade is how I manage my risk. Okay, so I don't typically manage a loser when I'm building a credit spread. If the credit spread is losing, I just let it lose and I move on. The size of the trade is how I determine my risk, not a stop or anything like that. But you don't have to do it that way. And if you're going to be trading bigger than I trade, you might want to consider uh, using structure to figure out where to get in and get out. So here's a $5 wide trade. We're looking at 30 days out, 36 days, you can see right here. We're going to throw it into the Analyze tab. We're risking 248 to make 252. This is a 1-to-1 risk to reward ratio. The break-even line is 310, close enough. And as long as we're on the right side of that, as long as we're above 310, every day that goes by, this trade is going to make money. It's a theta trade. So we just have to sit there and let time go by and close it when it hits our target profit. If it falls below 310, then every day that we're in it, we're going to lose more money. Now, the only way that you can get max loss in this trade is if we stay in it all the way to expiration. If we don't stay in it all the way to expiration, we don't have to eat that max loss. As time goes by, the loss will get deeper and deeper and deeper. And it wouldn't matter if price does not continue to fall. It would just matter that we're below the break-even line and each day time goes by, causing us more and more loss. So one of the things that you could do to manage this position is you could draw a line in the sand and say, well, if it breaks structure, I'm getting out. There's absolutely nothing wrong with that. You could see that if today Alibaba fell to $300, we could kill the trade and we would lose some money, but not the entire $252. We would lose $45. Now, if we stayed there and price moved for a week, we go back to 310, we can see that a week later, the loss didn't get any worse because theta decay is a small thing each day. Right here, we can see the theta decay. Okay, so it's not drastic or extreme yet. If we let another week go by, you can see that now we're at a loss of $57, but still not $248, which is the max loss. So we have plenty of time to let this trade mature, even if it is way down at $300, even if it's in the losing side. We don't immediately have to kill it. We can let it come back again. You can see where Alibaba makes those big moves and then fades for a few days. And then it runs up some more and then it fades again. So the reason that I'm talking this through with you is because if we pull the trigger today and Alibaba falls down to $293 or $300, yes, the trade is losing at that moment. But it has a month. And you have time to give it to where each day, yes, you're losing a small amount of money. You're losing a little bit more every day. But as long as it doesn't break main structure and it's holding above our ranges, then you could perhaps give it room to mature. You don't have to, though. That's the main thing. So if you jump into the trade today and it continues to fall, you could just kill the trade, get out of it, and move on. Right? You can see that we're up on the pre-market. You could be looking at that line in the sand and say, okay, well, I want to get in after it breaks this level here of resistance, and I want to see increased volume coming in. And if all those conditions are met, maybe that's when you'll put on the trade. That could also be your line in the sand to kill the trade. If after you get in, maybe a day or two later, it comes back down and starts to threaten that level, you could at that point decide to kill the trade. Everybody does their money management different. I don't try to encourage people to do it, quote, my way. So I wanted to offer a couple of different ways to manage the position. For me, I'm going to let mine play out. My typical management on a position, if it's losing and it's really big, is that I will let it get to 2/3 loss within 1 week of expiration. Okay, and it's important to add the words at expiration or a time frame for that expiration. If I'm putting on a 3-month trade, if we get within 3 weeks of expiration, I'm out of there. If it's a 1-month trade, if we get within 1 week of expiration, I'm out of there. So I give the trade time to mature. And I use 2/3 max loss for a lot of my spread positions, but I still put that max loss on a scale with time. How close to expiration are we? For this trade, guys, you could do just Friday. You could do a month. You could do 3 months. I really wouldn't recommend going beyond 3 months. And most of your sweet spot in the Greeks are going to be right around that 57-day range. The only other choice past 57 days is this 85 days out. That really doesn't suit me, but it is an appropriate choice. There's nothing wrong with 85 days. What you don't want to do is go all the way out to 120. Now you're getting too far out there, and you're getting into some negative Greeks, second-tiered Greeks. All right, guys, I appreciate your time. I look forward to seeing you at the next video.